Hello, welcome back at our channel. I'm Ange Fabrice Mahil as well. We have as I already mentioned, that we'll be seeing the world economic depression of 2008. We have had experience as an accounting field, but globally. Now we are going to deep the most of the time where world have faced the challenge of economic depletion, but not then. Even now, we are now in Middle East, in Asia, issue of fewer just alive. But how did the world overcome some challenge? Accounting is far more than a passive system for tracking corporate profits. It is the vital operational architecture that underpins global financial stability. During the 2008 Great Recession, profession acted as an emergency stabilizer, rebuild fractured trust. In today's complex economic landscape, accounting has evolved into a strategic tool used to navigate contemporary global challenges, particularly within sub-Saharan Africa. Now we are going to see part number 1, the role of accounting in overcoming the 2008 world economic crisis. The 2008 global financial crash was accelerated by a collapse in the subprime mortgage market and a total freeze in liquidity. Accounting standard setters, auditors, and professionals stepped to fix the structural rules that had inadvertently depending the panic. No, it was a very panic because the world war had just affected major department. Now, halting the fair value downward spiral. In 2008, strict fair value accounting, mark-to-market, forced banks to value complex mortgage assets at the heavily depressed fire sales market price. This triggered a regular cycle, falling asset value depressed bank capital reserves, forcing more assets liquidated. The International Accounting Standard Board, ESB, and the Financial Accounting Standard Board, FASB, stepped in with the emergency guidance, allowing the institution to use internal valuation models instead of distorted market price for liquidating assets. Liquidating assets means moving assets into money. Here, we'll explain it. These accounting adjustments stabilized the bank balance sheets and halted panic selling, shifting to the expected credit loss (ECR) model. Before the crisis, the old incurred loss model prevented banks from recognizing bad loans until an actual default occurred. This made banks look at financial health let up until they collapsed. To fix this too little too late problem, standard setters engineered a massive shift to forward-looking standard IFRS 9 and CESL. This forced banks to recognize and provision for potential credit losses from day one, building a much stronger capital cushion to absorb economic shock. Exposing of balance sheet liabilities. Prior to 2008, financial institutions hide massive, risky liabilities in special purpose vehicles that start entirely of their books. Accounting bodies completely overhauled consolidation standards such as IFRS 10 and IFRS 12 by redefining control. Accounting laws forced desk hidden risk back onto the main balance sheet, restoring global market transparency and exposing true corporate leverage. Now, part 2, we're going to see the role of accounting in overcoming contemporary challenges in sub-Saharan Africa. Today, the global economy faces unique challenges including high inflation, rising goods sovereignty debt, climate vulnerability, and severe capital flight. For sub-Saharan African countries, modern accounting practice serve as powerful policy tool to drive economic resilience and sustainable development. Number 1, attracting foreign direct investment. FDI via IFRS and key IFC. Sub-Saharan African face a massive financial gap for industrialization and infrastructure. By adopting international financial reporting standard, countries give local businesses a universal language that global investors trust. For instance, the Kigali International Financial Center, KIFC, leverage strict compliance with international accounting standards to position Rwanda as a premier transparent financial hub. This high level of reporting quality eliminate information asymmetries, mitigate perceived regional risk, and attract international venture capital. Number 2, safeguarding public resources through accrual. Many regional economies face fiscal deficit and rising public debt burdens. Traditional cash basis accounting often hides future government liabilities and pension obligations. Transitioning to international public sector accounting standard, it thus allows governments to track their true financial position, assets and liability accurately. By implementing automatic accounting framework like the Integrated Financial Management Information System, countries can optimize budget execution, curb public sector corruption, and ensure that every unit of tax revenue is utilized efficiently. Combating illicit financial flows and tax evasion. That's number 3. Sub-Saharan African loses billions of dollars annually to illicit financial flows and aggressive tax avoidance scheme orchestrated by multinational corporations. Now, advantages or advanced both can be applied by advancing or advanced foreign accounting and standardized transfer pricing documentation allow regional revenue authorities such as the Rwanda Revenue Authority to track complex cross-border transactions accurately. Clear accounting metrics help distinguish legitimate tax planning from illegal tax evasion, ensuring that corporate profits generated within African the nations are taxed fairly and invested into local economies. Let us move to number 4. Unlocking climate finance through sustainability reporting. Climate change is a defining challenge for sub-Saharan Africa, affecting agriculture and infrastructure. However, accessing international green funds require rigorous verification. The establishment of the International Sustainability Standard Board and its disclosure rules, IFRS 1 and IFRS 2, has placed accountants at the center of the green transition. African entities that implement robust sustainability accounting can transparently measure their environment, social and governance. Those have all impacts. This verifiable data is essential to unlock billions of dollars in global green bonds and climate resilience funds. We can move to number 5 now. Transitioning small and medium enterprise to formal economies. SMEs make up the vast majority of business in the region, but are frequently locked out of formal credit market due to a lack of trackable financial data. By adopting simplified accounting frameworks such as IFRS for SME, a small business can transform chaotic daily record into reliable audit-ready financial statement. This crucial clarity gives local commercial banks the confidence to extend loans, allowing small business to scale, create sustainable employment, and drive grassroots economic velocity. Now we can compare accounting as a crisis metric versus an economic architect. Let's dig it. Attribute of primary goal up to accounting focus. You can see many things that you can value that comparison. The primary goal is stabilizing a collapsing banking system, driving sustainable development and financial discipline. You can see, you can compare all of this to see how accounting is a very good option to overcome such to 2008 financial crisis, robbery, but up to today we can even handle them, especially in sub-Saharan African countries. We have so many challenges. Some of the countries are unlocked, but using IPSAS and sustainable and continuous doing of that, implementing those IPSAS can help us overcoming such challenges, either nationally, continental, and globally. Thank you. The next move will be seeing the one nation to one big goal, starting from Europe. What other nation have done in accounting that you can make as an opinion or pioneer, those who made the pioneering system, and we can benchmark. Why not? We can benchmark the nation which use IPSAS, IFRS. We can see what they have just done, which are good, so that we can copy the good, filter them, and include in our daily activities, either private or in public session. Ciao, ciao.